Okay, folks, welcome to this webinar, web-based seminar, and we're going to be talking about natural gas. So I'm going to go through my notes for about half an hour, and then I'm going to open the floor up to questions for about 15 minutes. And there's not a lot of time. The markets are open now, and we've got the FOMC meeting announcement later on today on interest rates. So we need to be up and running and have our trades in place by then, not only on natural gas, but other things as well. So let's start with the notes, and I'm going to switch and swap between different screens as we go along. Right, let's get going. Today's session gives you the framework, but in the Widowmaker natural gas trading course, which is releasing this month. I guess that's why a lot of you are here, to find out more about the course. But in the course, we're going to the exact setups, execution, and risk management strategies. So I'm going to read out just a few sentences here, which I think are really important, and we'll come back to them, I think, as we go along. But these are really, really key principles. And if you've got a pen, you can write this down. This webinar will be recorded. So if you can't stay until the end, you'll be able to watch it later on. We'll be sending out links later. But here's the first point. It's not just knowing what to look at. It's about knowing how to trade it effectively. And I think what a lot of you will have noticed, looking back on your natural gas trades over the months and even years for some of you, you'll look back and say, in hindsight, I knew exactly what I should be doing, but I didn't do it for whatever reason. And mostly those reasons are psychological. We'll talk about that a little bit later as well. But it's not about knowing what to look at. It's about knowing how to trade what you're seeing effectively, putting aside all of the fear and the greed and the doubts and the second guesses, all that sort of thing. And particularly in natural gas, because we change direction quite a lot. We're quite often long and then short and then long and then short. And so switching that mentality in terms of changing direction fairly frequently compared to other instruments that you may be trading makes it that much more difficult because of the mindset change. And you've got to kind of reverse your whole brain around and get back into the short side or the long side if you're already short of the market. So we're going to talk about the bare bones. Now, I've got a very simple theory about many things, and it's the cigarette box theory, but we'll get to that. The bare bones. There are 6 steps to setting up a natural gas trade. And once you know those 6 steps, you can repeat them time and time and time again in order to get that edge in trading the natural gas market that you need. And it's really pretty simple. A lot of people on X and on YouTube will try to complicate for you the natural gas market and make it sound like it's a very complicated, difficult market beset with things like contango, backwardation, forward swaps, options, the options market, and then the COT report with all the various players, and then the weather charts and what's projected for the next day, week, 2 weeks, 2 months in terms of weather, if you can go that far. There are all sorts of moving parts in natural gas, and my job is to try and simplify that for you, bring it down to brass tacks, bare bones, and simplify this to 6 simple steps. It is complex. Natural gas is a complex subject, and our job is to simplify that logical process for you. In yellow highlights, the goal is to simplify and structuralize. I didn't even know that was a word, but it is one of the most complicated but most profitable markets in the world. The reason why a lot of people want to trade natural gas, and a couple of good reasons, I think, and there are a couple of good reasons why you should avoid it probably, but one of them is because it's a highly profitable market. Natural gas can move 5, 10, 15, 20, and even more % per day. And of course, traders are looking for volatility. All traders want volatile markets. We can't trade unless there's movement in the market and volatility. Natural gas offers that almost daily, and that's what makes traders interested in it. But at the same time, it's a very complicated market too. It's not easy to trade, but it is possible to trade if you know the simple steps, and if you can boil that all down to a liquor, as they like to say in the States, not the alcoholic type, but a liquor, a substance, or the essential oils of what we should be doing. We can trade this market quite effectively. And that's what I want to do today, is to tell you a little bit about how I approach the market and how you can do so. And also to let you know that I'm releasing a course at the end of this month, at the very, very latest, the first week of April. So between now and the first week of April, I will be releasing this natural gas course. And what I'm trying to do today is just to give you a little bit of an idea of what will be in the course, and just give you a little bit of a head start really as well in trading your own natural gas. So if we can't put it on the back of a cigarette box, it's not worth it at all. And if you apply this idea to most of the things that you do in life, you should be more successful than not. So I don't want to give you books and books and hours of video on natural gas trading. I want to be able to write what is important down on the back of a cigarette box, which is exactly what I will do in the course. Of course, that will be a précis or a summary. But once you've been through the course and you've been through quite a lot of notes and there's a video associated with it, once you've been through that, you should be able to liquor that down into the size of a cigarette box in terms of what you need to do. So we're covering a high level approach, but inside I'm going to try and summarize it today, but inside the full natural gas mastery course, and I've actually called it the Widowmaker Natural Gas Trading course, we're going to deeper dive into the exact setups and execution and strategies. So here's another really important sentence for you to remember. Direction, which way the market is moving in the medium or longer term. In other words, the general swing direction that we're in is not the most important thing. It is pretty important, but it's not the most important thing. That's one part, and that actually the first 3 steps in this process that we're going to go through right now covers picking a direction for the market. Now, it's a pretty binary choice. It's either long or it's short. Maybe it's not binary. Maybe a third choice is just to stay out of the market. But in essence, it's a pretty binary choice. Are we going up or are we going down? And the first 3 steps in my system will help you, not really a system, it's kind of common sense, but will help you determine or pick a direction for your trade. And once you pick the direction, the harder part starts, the slightly more difficult part starts. Picking a direction is not too difficult. In fact, you could flip a coin and just go like that. You could probably still make money out of trading natural gas if you did that with a coin flip and picked heads or tails, long or short. But we do want to try and get an edge on the direction part of it as well. So we're going to talk about that today. Mastering natural gas trading, the smart edge. All right. And these are just notes I've made. I've typed these out. I've put some colors in here. I haven't put any graphics in. So as I go through these notes, please make your own, or when you have a chance, rewind this or replay it later on and make your own notes. So here's a quick intro. Why natural gas is unique, my experience, and what traders get wrong. So it's a 6-step structured approach to natural gas trading. And the first 3 steps are about finding direction. But why? It's not everything. So we want to try and get some sort of sense or idea of whether we should be going long or going short. That's as simple as that. But it's not the most important thing, as I mentioned earlier, but we do want to try and find it at least. And the next 4 steps, the next 3 steps rather, 4 to 6, are about executing the trade. And this is where the money is actually made. So don't get obsessed with finding a direction or picking a direction. Learn these ideas, these concepts. Obviously, in the course, I'll go into a lot more detail about this. I'm going to give you the bare bones here. And let's start with steps 1 to 3. Establishing direction, but not overrating it or placing too much emphasis on direction. Direction is important, but not as important as execution. Many traders overfocus on getting direction 100% right, when in reality, proper execution and probably even more important, risk control make the difference between winning and losing over time. Really, in terms of priority, in terms of emphasis, the most important thing is risk management. The second most important thing is execution in and out of a trade. And the third, the least most important thing, is the direction that you pick for your overall idea. We'll cover all of those in this short sort of précis. As a side note, I will cover also futures. Now, a lot of people say, well, what should I be trading? Should I be trading oil, cold, natural gas futures? If so, which broker? Or the continuous price? If so, which broker? And so on and so on. And there are also other instruments you can trade. What I'm going to do in the course is I will cover what I personally trade. I trade both the futures and I trade the continuous contracts, but I do not trade oil and I do not trade cold, K-O-L-D. And I'll explain in the course the reasons why. There's no need to trade those leverage or inverse ETFs if you've got a good grasp. And I'm basically a purist. I like trading the pure natural gas futures most of the time. And when I can't trade the futures, if there's a rollover, a monthly roll, contract roll approaching, I'll switch to the continuous trading natural gas ETF over a Pepperstone and trade that until the roll has passed and has settled down and I have a bit more control over the continuous contract. I'll explain all of this in the course. Let's go through points 1 to 3. First of all, market positioning and sentiment. Now, for that, I use the COT report. You only need 1 page for this, and that's called the COT report. I'm going to show it to you right now. before I do that, I'm going to run through these couple of points here. First of all, we want to know how the market is positioned. We want to know what the hedge funds are doing. We want to know what the institutions are doing. We want to know what the market makers are doing, the hedgers, the retail traders. We want to know how they're positioned. And basically, we want to be positioned in the path of least resistance to figure out through that slight maze of information which way the market is generally positioned. And because of that positioning, and it's not always clear, it's not always directly correlated, but according to that position, which way is the market most likely to go? So we'll come to that now. I'll show you the COT report. I'll show you how you can look at it, the sorts of numbers that I look at. I look at the forward ribbon. I consider things like contango and backwardation. I'm not going to go into that now, but contango basically means there's an oversupply bias, and backwardation means there's a scarcity bias. And I also like to compare where we are right now today to the 5-year average at this time of the year today. So I take all of that information and I put it into my melting pot and I come up with a direction. There's another one that we'll talk about, that's weather, and there's a couple of other things here. There's the EI storage report, a few things that you have to keep an idea or an eye on. But the most important thing, and probably the easiest to understand out of all of these, is the COT report. If I can find it, I'll go straight there. And here it is. This is the COT report at barchart.com. And it's free. Anyone can sign up here for free. And what the COT report does is gives you a number of things. First of all, you get all the prices. You get the ribbon or the curve for the forward contracts. So you can see what we're trading at the current month, the front month, the following months. We can go through May, June, July, August. Not much difference in price, actually going slightly up. Quite interesting, actually. More demand going out into the future. And then we also can look at the commitment of traders' positions. Where are commercials, producers, managed money, non-commercials, swap dealers, and other reportables? Where are they all positioned? Are we at extremes in positioning? Are we biased to the short side or to the long side in each one of these categories? Which one of these categories plays the most influence in the market in the short term and medium term direction? The retail traders, what are they up to? How are they positioned? Sometimes we want to be opposite to the retail traders. That's people like you and me, by the way. Swap dealers, the hedgers, the market makers, what are they doing? And so we can get all this information. It's released on a regular basis. You can also see where we are in this chart compared to the 5-year average on this day, today. You can see how far above the 5-year average we are. 5-year average is at 2.7, and we're at, $4.15 right now. So that's the COT report, folks. And what I'll do in the course is go through the COT report with you and show you exactly what we look at and what we pay attention to and how that affects our decisions or deliberations on the direction of the market. And that really covers number 1 and 2, the market positioning, the sentiment, the forward ribbon, the large specs versus commercials, who's pushing the market, extreme positioning, often when even commercials and hedgers or hedge funds, whatever, if they're all extremely positioned, very, very long or very, very short, sometimes that can be the opposite sign. So incredibly overcommitted to the long side could mean that the market might want to correct sometime going forward. All sorts of things we can look at there, but we again try to simplify it and make it as easy as possible to understand. The other thing I like to look at, or most traders like to look at, is the weather. I don't look at short-term weather all that much, but I do like to keep an eye on what's going on. It doesn't influence my decisions as much as some of the other things, but what I would suggest to you and highly recommend, if you are on X, I'd suggest you get this. I don't know what it's called anymore. It's called X Pro now, but it used to be called something else. But whether you do this or not, this is nice because you can get all of your Xstream feeds on one page. You can see what I've got, a few things here. Investing.com, Financial Juice, Zero Hedge, Bloomberg, Financial Times, etc. I've also got natural gas weather. And there are a couple of, and they've got a website as well where you can subscribe and you can get some info on this page as to what the weather's doing. And they update fairly regularly on X for free, I think, unless it's just pro members. I don't think so. I think it's free. And then they've also got a website. There are also other weather websites. Now, basically, natural gas works off weather in the shorter term, irrespective of all the other variables. And when it's extremely cold or extremely hot, there's more natural gas used up, and therefore demand increases, and therefore the price may go up. And again, it's not a perfect correlation, but there is a good relationship between weather and the short-term price fluctuations in natural gas, particularly over the weekends. Anyway, there are a couple of other places you can go. There's another website called Energy Rogue. Brian's in the room, in the house. Thanks for joining, Brian. And I noticed on your website, Brian, here, download your free energy trading toolkit for natural gas and crude oil. There's a little pop-up box on Brian's site there. Energy Rogue is the name of the site. And they have all sorts of awesome stuff. I'm a member. In fact, my face is even on this page as a member of Energy Rogue. And it's another place where you can get all sorts of fantastic information, including weather and a whole bunch of other stuff. Click the video to play to find out more about it. There's a lovely picture of Brian on the website. Very handsome in that picture, Brian. Nice shot of you. All right, so that's weather. And then I'm going to carry on going down quickly because we don't have a huge amount of time. The biggest contributors to weather: the winter cold spikes, demand surges; summer AC demand and power plants, demand surges; hurricane season can lead to supply chain disruption; and then usage for user forecasts, use forecasts, 5-day, 10-day, 14-day, to anticipate shifts in the weather. Often you'll get shifts in the weather over the weekend, which might make you not want to hold your trades over the weekend, because we often get gapping over the weekend. All I've been telling you about is the three things that I look at to determine the overall direction for the market and my directional bias. Now, I may have a directional bias. It does not mean that every single trade I take will be in that directional bias. I'll show you what I mean by that. We have a chart on here right now, which I'll show you, which you may be familiar with from X and YouTube. These are the trades that we've taken over the last number of days in this current contract on the futures. And you can see I've taken 1, 2, 3, 4, 5, 6 short trades, but I've also taken 2 long trades. Even though these long trades were hedges, if you were a swing trader buying the bottoms, you may have been tempted to not only exit or hedge your position there, but also to add a long position. I didn't do that. I just hedged my position. But my bias for this market is down, and because of a couple of reasons, and I'm going to show you what those reasons are shortly. But I've also taken a couple of long trades, even though they were hedges. So directional bias does not mean that I won't trade in the opposite direction. It just means that I have a bias. And most of the time, I'd like to be trading in the direction of that bias. Now, I want to point out one thing here, which I neglected to mention. Yeah, well, let's talk about news. And then, of course, there's news. There's the EIA storage report on Thursdays, which shows how much natural gas is in store. And once again, it's a supply and demand situation. If there's too much gas in storage, it will tend to drive the price down. Too little gas in storage, the price will tend to go up. There's also the Baker Hughes rig count on Fridays and future production shifts. That's interesting. Doesn't play an immediate, instant role on the market. And then LNG exports, another really good one, which I think is going to be more in vogue and more interesting in coming weeks, months, and even years, as the US looks to export more liquid natural gas. And that should actually impact demand, increase demand. So the US sending more gas, albeit in liquid form overseas, means that they need to produce more. There's more demand. And then, of course, geopolitical risks. We all know about what's going on right now. Now, take all of those three things and put them into a pot and mix them around a bit. Add a little bit of technical analysis, maybe a long-term view. Maybe think about where we are on the price overall. Generally, if we're above $4, which we are right now, we should be looking to the short side no matter what. And generally, if we're below $2 or $2.50, let's say, we should be looking to the long side no matter what. Just a directional bias. It does not mean that we'll only be trading in those directions, but it does mean that that's a directional bias. So anything around, remember, natural gas is a ranged commodity. Most of the time, we trade between, I don't know, $4 and $2. I'd say 70 to 80% of the time. So it's a ranged commodity. And we want to be in any ranged commodity, we want to be selling the tops and buying the dips. And that's what we look to do on natural gas. And one way to easily define where the top is, it's roughly around $4 and above, and the bottom is roughly $2 and below. So that makes it pretty easy. So once we've got a directional bias, and of course, I'll go into a lot more of this in the course because it's not difficult. It's slightly complicated, but we're going to sort of squeeze it down and compress it all down to just something that you can do literally in 5 or 10 minutes when you start your trading day. Those 3 steps take you 5 or 10 minutes, maybe half an hour if you're going to be incredibly diligent. Maybe the first analysis of the week would be the first, you might take a little bit of time. But all we want to do is directional bias. That's all, just want to establish that and say, I think we're generally going up this week, or we're generally going down this week. That's all we want to do. And then with that in mind, we go to the next steps 4 to 6, the next 3 steps. So let's read through this a little bit more carefully. Steps 4 to 6, executing the trade. Let's say, as we've decided the directional bias for the current market for this week. This week's almost over. We've got a contract rollover coming up next month. So this week's going to be a bit messy, but let's just assume that for now, that our directional bias is short for this week, and therefore we want to be looking to sell. That's the only thing we need to know before we get to steps 4 and 6. Now we can look at some of the more detailed specifics on some of the charts. I've got a chart over here for your information, which for some reason I shrunk back down again. But the base chart that we're going to use for all of this is the natural gas chart at the Henry Hub. This is the day chart of the Henry Hub natural gas price as provided by the New York Mercantile Exchange. And that's where we are. You can see we're right up above $4 and right at the top of the range. Now, if I squeeze this out and make this into a weekly chart, I just want to illustrate what I've just been saying to you. This is natural gas going back to about 20 or 30 years. And you can see most of the time we're below $4 and we're above $2. That's all I want. Well, let's say above $1.50. We did actually get down pretty low on that last dip, but not quite as low as the last period. But around about $2, $1.80. From there, we want to be looking to buy. And from the top side, $4 and above, we want to be looking to sell. Now, we've been short this entire last contract, the current contract that we're trading in right now. We've been entirely short on this contract. You can't see it on this chart, but because we're above the $4 level, we got to almost $5, in fact. That was my target. If you remember following me on YouTube and X, we were looking for $5 to be at top and then to reverse. Now, I'm not saying we can't get any higher than this, but we might get higher, but maybe we've reached the top. Be watching this very closely. So we want to look at the long-term charts and key price levels. Weekly and daily trends show the bigger picture. So don't go into your 5-minute charts, your 1-hour charts, your 15-minute charts. You can use that if you want to, if you're day trading natural gas. I'm a swing trader, so I look at 4-hour charts, day charts, week charts. That's all. So my scalping chart is my 4-hour chart. Sometimes I go down to the hour chart, maybe, perhaps sometimes. But we're looking at daily and weekly trends to show the bigger picture. As I said earlier, key price levels 2 to 250, major support, kind of the bottom of the range, and $3.50 to $5, major resistance, kind of the top of the range, the profit-taking area, and the value zone at the bottom, profit-taking area at the top. And then, of course, we get mean reversion tendencies. Natural gas often snaps back when stretched. We have 4 moving averages that we use, nothing else. The 20 period, 50, 100, 200 period, simple moving averages. And we use those only for mean reversion. So when the market has returned to a moving average, let's say we're biased short, the market has moved up to the underside of a moving average in confluence with a few other things, perhaps. We want to be looking to sell that as it reaches the 200, performs a reversal candle pattern, and starts moving down. So the 20, 50, 100, and 200 period simple moving averages are not for crossovers, not for MACD. We're not using EMAs, DMAs, VWAPs, nothing like that. Just simple moving averages, and they act as support and resistance for mean reversion trades. We either trade towards them or we trade away from them. Pretty simple. The 20 period moving average is the short-term, most important one for short-term trends on the 4-hour chart. Timing the market, just a couple of notes here that you, again, just might want to think about as you're looking at the day of the week. Nat gas moves differently depending on the day, as most instruments do. Mondays gap from the weekend news. As I said, we may have weather shifts in the weekend, and normally it's the weather shifts that might make the market move gap one way or the other on Monday, as those orders get filled incredibly rapidly the moment the market's open. Thursdays we get the EIA storage report, which I'll cover in the course in more detail, and then Fridays, as you'll probably also know, position squaring and the rig count. The rig count's just news, which may in fact impact the price. But there's often position squaring, and traders will often get out of the market on a Friday. And whatever direction that we've gone in, the market is likely, I wouldn't say likely, has a tendency to counteract or move in the opposite direction. If we've been going up the whole week, on a Friday, you may expect some profit taking and the market to pull back a bit, particularly going into the weekend when most traders know that there's the risk of the weekend gap. And we don't know which way the weekend gap will be because we don't know what the weather will be or what the forecast will change to be. Brian says Tuesdays are reversal. Is it Tuesday or Thursday? Tuesdays, reversal Tuesdays. Folks, I'll get to some of your questions as we go along. I'm going to try and get through my notes first. Now, next thing is, and then recognize these patterns. It gives you better entries. Of course, just keep in mind what happens on Mondays, Thursdays, and Fridays. Now, step number 4, and probably the most important one, And this is where the rubber hits the road, the 4-hour chart execution and hedging, my hedging approach. You don't have to hedge. Many countries don't allow hedging on a single account. What I mean by hedging is if I'm short on natural gas and I think it's going against me and I want to get out of that trade, I simply buy an equal amount of natural gas on the same account whilst keeping the short trade open, therefore nullifying my short trade, equaling it with a long trade. And if the market does go up, I can take profit on the long trade. And if I still think it's going down, in other words, if my directional bias is down, we've taken profit on the long trade that I used to hedge the short when it started moving up. I can take profit on the long hedge, add that to cover the risk of an additional short position at that higher level, and then write it all down, the original position and the new position, plus the profit I took from the hedge. That's the way I trade natural gas and many other instruments. And there are all sorts of other decent reasons for using hedging in your trading techniques. If you cannot hedge on your broker's account because of the broker's rules or because of the country that you live in other words, what you can do is open 2 accounts, identical accounts if you want to, for example. And if you want to hedge, you've got your short trade on your one account, you take another position on your other account, a long position. It doesn't have to be the same size, by the way. It could be sort of 50% if you only want to hedge a little bit or whatever. But you take that position on a different account and you run those 2 accounts separately, but together, if you know what I mean. That's one way to get around the hedging issue, particularly in the US and maybe Canada too. And I think you can do it in the UK. I'm not sure. All right, the 4-hour chart execution. It includes hedging, but as I said earlier, hedging is not the most important factor. If you can hedge, all the better. There are not only technical benefits for hedging, but there are also enormous psychological benefits for hedging. And considering, and please write this down or just remember it, considering that most traders lose money because of psychological issues and because of poor risk management, considering that, you should learn to hedge because that will eliminate a huge number of the issues that you're facing with your trading psychology, your mentality, the fear of losing, FOMO, greed, fear, all of those things which just swarm in on you when you least expect it. And when you're hoping to be in a good trade and you mess it up completely, when you look back, you'll discover it's only because of something that went on in your head or you just mismanaged your risk on the trade. The 4-hour chart is a key for execution. And basically, we're looking for an overall direction. And then we're looking to enter the market when we get a 4-hour trading signal at a particularly important trading level. Basically, what we want to do is set a direction. It doesn't matter if we're wrong or right on that direction. That's not the important thing. But the important thing is to get a bias. We want to have a bias. And we want to have a line in the sand that tells us when our bias is wrong. So let's say we drop below $3 on natural gas. My directional bias was long, let's say. And we drop below $3. And this is a very bad example, actually. But let's pick it around. If we drop below $4, if we drop below $4 on natural gas, and if you were long, and we drop below that level, that's when you can change your directional bias by saying the line in the sand was $4. We broke and closed, not just broke, but closed below $4. And therefore, my directional bias has been invalidated, proven wrong. I was incorrect. And incorrect doesn't mean you got it wrong or you were bad or your analysis was poor. Just means you were incorrect. That's all. Doesn't mean you're a bad trader or a good trader. It doesn't mean anything at all. And therefore, your position or directional bias has been invalidated and you get out of the trade. So we look for 4-hour candles that show signs of reversal. I've got a pet packet of reversal candle patterns which work incredibly effectively, work very, very well, particularly on natural gas. And when they're used in certain combinations, I definitely enter a trade whenever I see them. But then I also use risk management to control that trade and decide when to get out of the trade when I'm right and get out of the trade when I'm wrong. So where do I take profit and where do I exit the trade if I'm wrong? Very often, I'll let the market tell me when it's time to exit rather than setting a predetermined level. And I think that's another mistake a lot of traders make. I said on X yesterday, I think natural gas is going to $3. I said $3.75 and then $3. Now it's moved back above $4 now, and I could be completely wrong. It does not matter. My directional bias remains short as long as we're above $4. And all I'm looking for now is reversal signals on the 4-hour chart against a key or important level. And it could be an order block. It could be one of those 4 moving averages that I mentioned. It could be a Fibonacci level. It could be a trend line. It could be a channel line. It could be a gap, a weekend or a rollover, contract rollover. it could be a number of different things, which I obviously detail very specifically in the course. But when I see all of those things combining, a reversal candle in the direction of my bias at a key chart level with good risk reward dynamics in play, in other words, I've got a good opportunity to make some money on the trade and I can manage my risk without risking too much on the trade, I'll enter the trade every time. And also, I don't always enter the trade with my full position. And what I'll often do is edge into the trade until the line in the sand is broken. When the line in the sand breaks, I stop edging into the trade and I'll hedge it and stand aside and wait for the next move. But until then, I might enter with, let's say, 25% position size, and then add another 25 if I get it at a better price, and another 25 and another 25. I normally go in sort of quarters. Very often, because I get the direction and the entry pretty accurate most of the time, very often I don't get beyond 25 or 50% on my position size. And that's fine with me because natural gas can move 5, 10, 15, 20% a day. And so you don't need a lot of size on your position. Of course, if you want to make a huge amount of money very quickly, and natural gas can provide those sorts of really big moves, and you're willing to risk whatever money you're willing to risk, that's fine with me. I don't care. If you want to gamble, that's fine. A lot of people gamble. If you really want to just make consistent profits, you don't need to get in with more than a quarter size position compared to what you might normally put on, or a half size position or a 3/4 size position. So we're looking for those signals on the 4-hour chart. We wait for the 4-hour candle to roll over. We don't get into the market before the 4-hour has rolled over. And so there's nothing to do for 4 hours at a time when you're trading natural gas, even though some people think it's like you got to be on the 1-minute chart or the 30-second chart and trade it with your eye to the charts like a hawk. That's not the way natural gas needs to be traded. There's plenty of time in that 4-hour candle chart setup to get into trades, get out of trades at the best possible prices, and there's no need to rush it on a 3-minute, 5-minute, 1-hour chart even. And then secondly, risk. I've mentioned risk management already. What I do like to do is to hedge more than I do use stop losses, although sometimes I use stop losses. And normally when the trade goes against me, I go past my risk level or stop or line in the sand, whatever it might be that I've put in place. When the price goes beyond there, I'll simply normally put a sell or a buy stop order in at that level in advance. And when the price breaks through there, I'll often just enter the hedge trade and wait to see what happens. If the market doesn't carry on moving through and moves back up again, let's say, in the direction that I picked, I'll just remove the hedge and leave the original position on. But if it keeps on going in the direction against me, I'll just keep the hedge on and at some stage take the profit off the hedge and add another position to the direction that I want to be in. No stop loss dependency. And I can't stress enough how much this will help you in your trading if you learn to hedge. It reminds me of going back into the, I don't know, was it 3, 4, 5 years ago when everyone was telling truck drivers and fitters and turners that because of AI and automation, they'd all be needing to look for new jobs. And the buzz phrase was learn to code and you'll be fine. If you learn to code, you'll be fine. So my buzzword for today is learn to hedge and you'll be fine. Learn to hedge. Really, really important. I really believe in it. And I guarantee you, there are hardly any traders on Wall Street and in big firms that don't hedge one way or the other, whether it's using options, whether it's using the same instrument that you're trading, whether it's using some other instrument in the same space or niche, whatever it might be. People just generally do hedge on Wall Street and in London and all the other places. And at the Hang Seng, people tend to hedge. And the reasons are for the reasons that I explained to you. You're able to control your risk much more easily, and you're also able to control your emotional degradation much more easily too. Trading is incredibly destructive to your good mental health if you allow it to be. Most people do allow it to be destructive to them. They're not able to manage it. They don't know how to. And if you can't do that, if you're just unable to do it, hedging is one way to get around that until you can learn those mental disciplines yourself. So yeah, so it neutralizes risk. The first thing you want to do when you're hedging is to get rid of risk. Most of you trading natural gas will have found that you've taken risk, you've added too much size on, you've overtraded, you've taken, you haven't used a stop loss or a hedge, you've got mentally and psychologically into a turmoil, you got weirded out about it, you lost all your money, your account was blown, you didn't want to tell your wife or your husband because you lost the savings, and the whole thing becomes an awful, unpleasant downward spiral from which it seems impossible to extricate yourself, particularly when you've still got an open trade and and you're 50, 60, 70, 90% down on your account. It's a tough one to trade, guys. And my job in this course is to teach you how to trade natural gas with very low risk, with high success rate. My success rate on natural gas, and I'm willing to show course members if you want. I think my trading group members will know in my live group, probably closer to 80%, probably higher than most of the other instruments that I trade. I think I have about an 80% win rate on natural gas because I can combine a very high win rate, 80%, with the incredibly volatile moves that natural gas offers on a daily basis, 5, 10, 15, 20%. I can, and also by using smaller position sizes. In other words, I don't have to risk a whole position. I can risk 25% of a position, and the market can move 4 times more than any other market, and I can still make the same amount of profit. It's a very difficult instrument to trade, but it's highly profitable, and it's possible to simplify it, as I've tried to, rather clumsily, I have to admit, as I've tried to sort of show you in this webinar. It is possible to simplify it, to methodize it, and to reduce and minimize risk to the point where it's no longer a factor. Losing all your money is no longer even part of the equation when you're trading natural gas if you do it properly like this. And the only thing you'll be worried about is cutting your losses as quickly as possible and letting your winners run, which is what we try to do. Many of my winners are, in terms of dollar terms on the price of natural gas, minimum 20 cents, 30 cents, but very often I go for 50 cents, 60 cents, 70%, a dollar, cents, a dollar. I think we made $1.15 on the last move down on natural gas on the previous contract. So it's possible to do it. And my job and my desire, what I want to do in this course coming up in the next few weeks, and please stay tuned for the announcements. They're coming pretty soon. But my job in this is to help you navigate this, not only survive natural gas. So my job is to help you not only survive the natural gas markets, but to thrive in your trading, to become profitable, to be able to make money out of trading natural gas. That's what I think everyone wants, but without the risk, or at least without the extreme risk that you may have already experienced. We've gone through a 6-step framework, but knowing what to check is just the start. The real challenge is applying it consistently. These are just notes I made: executing trades well and managing risk. And that's why we've got the course. We've also got a little flow chart here, which is built out in the course, which I'm not going to go through now. And then there's the 6-step process, which I've précised below. And somewhere I've got a cigarette box size précis. It's right down here, right at the bottom. So there you go, folks. I just wanted to really try and, I think, a couple of things. First of all, encourage you that natural gas trading is not impossible. It's not for geniuses. It's not for people that have been trading for 30 years plus only. But anyone can learn how to trade natural gas. It's definitely more complicated than trading some of the other instruments that you may already be trading. So what I'm trying to show you is that there are ways, if you're interested in this instrument, it's exciting, it comes out of the sea, out of the ground, it powers our lives, it has massive daily moves, it's tradable. You can trade a variety of different instruments. Most brokers, in fact, almost all brokers, offer natural gas, either futures, oil, cold, continuous ETFs, whatever it might be. It's all there for you. And this course that I'm releasing this next couple of weeks, I really do believe, and in fact, I put money on it, that it will help you to become profitable in your natural gas trading, but not only profitable, but confident, excited about going to the market, looking for opportunities, making profits, banking those profits, and becoming a proficient natural gas trader. And I think I can help many, many of you do that. I don't like seeing the comments the next day on a Monday or a Tuesday after natural gas has crashed 30%, 40%. Everyone was long and everyone got wiped out. And I get messages galore in all my inboxes. I want to say one final thing. Natural gas is a ranged product. We tend as humans and as traders in general to be optimists and bullish in our mentality and our thinking. Traders tend to be long natural gas way too often. We should be short more than long. And most of the time, when the price spikes up into those juicy, delicious $4, $5 levels, we're looking for the best shorts of our lives. So, folks, hope you enjoyed the webinar. I'm going to get to some questions very quickly. I'm going to see how many. Let me just start at the top. So, first come, first served. We've got about 15 minutes at the most, and we'll just go through some of these questions. So, Jonathan, you find that natural gas gaps towards the direction it was moving in the last 2 or 3 hours on a Friday? Yeah, definitely gaps on a Friday, Jonathan. Depends on your trading strategy. That normally you would try and be out of the market by the weekend. I often hold my natural gas contracts over the weekend. I'm not too worried about short-term weather volatility because I'm a swing trader. But if you're a day trader, you'd be out of the market most of the time. Can we get access to the doc file being presented? Yeah, Aditya, yeah, it'll be in the course, basically. These are course notes, which I'm just sort of sharing on the video for you. You missed the hedging strategy this year. You could have used that. Yeah, we'll talk about hedging a lot in the natural gas course. The two key things to define the direction of the market is not the most important thing, is to define an entry using very simple, those last three steps in the TA process. And then that's the kind of the second most important thing, getting an entry and then defining your entry and your exit prices. But the most important thing is managing risk. And the best way to do that is by hedging. Right, an order block and how these are identified. Anton, thanks for the question. I'll get to that in the course. I don't have time for that now. But an order block is basically a place on the chart where there is a lot of volume, the market changed direction, found support or resistance, and you can draw it on your own charts. There's an indicator on TradingView. This is the TradingView chart. And if you go to indicators, it's called, so it's this one over here by Emery KB. And you can just copy that onto your chart. It's free. It's the one with 22.3K subscribers. And if you put that on your chart, I think it's already on my chart, but it is on my chart. It'll draw these automatically for you, these green order blocks below. Anyway, just MSB, OB, it'll draw those order blocks on your charts. The indicator's free. G'day, Kishwar Suberi. Lovely to see you. Kishwar's been a member of ours for a very long time. G'day, Brian. If you scalp, should you only take one position a day? Laura, I'm not a scalper, but no, I don't think that's a good rule. I don't think that's a sensible rule. You can take as many positions as you want. In fact, if you lose the first three positions, it's more likely than not that the fourth position you take is likely to be the winner. I don't trade cold or boil, Bruce, and I give the reasons for that in the course. I don't like to trade those at all. Thanks, Brian. Great win rate. Yeah, I don't trade cold or boil, no. How many trades a week do I typically take? Jonathan, I'll give you an example. Well, this week I've taken, you can see exactly how many trades I've taken this week. Well, this is over about 2 weeks, really. This is going back to, this is over this contract, the current front month contract, but this is going back to the 4th of March. So it's actually 2 weeks. I've taken 1, 2, 3, 4, 5, 6, 7, 8 trades over 2 weeks. So 4 trades a week. Not normally that much, actually. Normally it might just be 1 or 2 trades a week. And in the last week of the month, I don't normally trade on the futures contracts because of the rollover. And therefore I trade on the continuous ETF over at Pepperstone. So cold and boil, I really wish I had time to talk about this. I could talk about these for an hour right now, but there's just no time. Can you explain the reason why natural gas is trading at $4 during March as opposed to 2 or 3? I don't want to talk about the specific price at the moment, Ambassador. You can go and check out my videos on YouTube if you want to. Advice about using leverage. I don't use leverage, Gibbon, so I can't. Any advice I give on leverage won't be very useful. I don't trade with leverage. I don't trade boil or cold because they're leveraged and because they decay and they're not directly tracking the price of natural gas and they're a derivative, basically. Martin, I don't understand German, unfortunately. Wie lange der Kurs? Der Kurs. I don't understand that. I do understand Dutch, Martin. If you could translate into Dutch, that would be fine. Why are you creating the course? What's my motivation? I think I explained that just now, Adam. First of all, to help traders actually learn to trade natural gas, but also to make a bunch of money. So my business approach, and you may or may not like it, but my approach is to, I trade. I've been trading for 20 years. That's what I do. Mostly I spend my day trading, but sometimes I can sell something here or there that's useful to other people that they're happy to pay for. And that can make me a little bit of extra cash to put it back into my trading account or go on a holiday or do something like that. I've got other interests as well. I'm starting up a drone company. Not necessarily, I like flying drones. I probably won't doing much in the company, but it's a drone company for surveying and photography and sports and that sort of thing. And you might ask the same question, why am I doing that? Well, because I enjoy it and I like it. I like teaching and I like to make a little bit of spare cash, a little bit of a side hustle, but I get it. A lot of people will say, well, why are you teaching rather than trading? Well, I actually do both. I trade quite large accounts and I trade them all day long. I trade 18 hours a day. So it's not like I don't trade. That's what I do. But I also have done some of these I've done a couple of courses now. This is my second course. Where can you see cold? It's KOLD, Smart Trader, KOLD. And you can find that on on TradingView. What sort of capital is required to trade HG futures? Jeff, not too much really. At Black Bull, my broker, which I've been with for a long time, and they're very, very good with natural gas. Quite good spreads, not very, reasonable spreads or commissions. Oh, what sort of capital? They allow, you can trade 0.1 of a futures contract, which is quite small. You don't need a lot of capital for that. But if you go to, there are a couple of other brokers which I could recommend. Capital.com, I've never used them, but a lot of people do. You could trade very small amounts there. The other one is Oanda, that's OANDA. And with them, you can trade tiny fractions of amounts. You could have $1 in your account or $10 and trade at Oanda, that's OANDA. And I've used them for a long time. They've been around for about 25 years, maybe 30 now. Reliable broker where you can trade very tiny micro lots. And if you don't want to commit too much money to a big, but confused with hedging, a simple method. Yeah. So I think I explained a bit about hedging earlier. Brian, that was fantastic. My questions, if you start with a clean chart, what are the key things you start with? Moving averages, Fibonacci, etc. What are the key fundamentals that you watch? Okay, so Brian, I have very clean charts. I don't like putting a lot of stuff. So I don't use oscillators. I don't use MACD. I don't use stochastics. I don't use the RSI. I do use Fibonacci retracement studies, as you can see on my chart right now, in fact. So I've got some horizontal lines. I've got 4 moving averages, which I detailed earlier, the 20, 50, 100, and 200 simple moving averages. I've got a couple of order block lines drawn in here randomly, a couple of chart patterns that I drew in myself, triangle there, and the arrows are just where I've taken my trades. I put those in myself, obviously. And that's it, really. And, there might be a Fibonacci and a couple of other lines, and that's it. I don't use any other oscillators or indicators myself. And the fundamentals, Brian, just as I explained earlier, the things that we look at, basically what's going on in the world, where's the price in comparison to the average of around $3.50, or we're way above there, way below there. What's happening in the news, what's happening in the weather, any major production news, any demand supply type changes, anything from the wells, anything from Henry Hub, from exports, LNG, tornadoes, typhoons, hurricanes. But generally, I just want to try and find a direction. And I'm even happy if I pick the wrong direction, doesn't really matter. But I stick with that direction until I'm proven wrong, despite what the fundamentals and all that sort of thing say. Now, you'll know, perhaps some of you'll know that I've been short on oil and long on natural gas for the last 6 months, basically. And despite what's going on in Ukraine, despite what's going on in the Middle East, oil prices have come down dramatically, against all expectations. And natural gas has actually gone up to, about $4, even $5 at one point. So, and those are my views from the beginning of the year. In fact, about a year ago, I've been short on oil for 2 years now. And so the fundamentals that I look at are often a little confusing. I'd rather look at my charts. So the fundamentals said we should be, buying oil, buying natural gas up the yazoo over the last 2 years. But in fact, the prices have come down. Natural gas got down to $1.50 a year ago, if you remember. Fundamentals are great. Of course, you should pay attention to what's going on in the world and in the news and in industry and in the weather. But often, the market will do completely the opposite. So, and that's why direction picking isn't the most important thing, but actually timing your trades, making sure you get a good high value, low risk, high probability trade, manage your risk, and that's the key to natural gas trading. What percent of the time do I use Elliott theory to trade natural gas, if at all? Gurav, I don't trade with Elliott waves. I understand Elliott waves very well. I've got all the books. Did all the studies decades ago. And the conclusion I reached, and it's my conclusion, and it's probably a little bit under-informed or naive or perhaps just skeptical, but I'm not a great fan of Elliott waves, and I don't use them at all. The hedge is the same. Yeah, Tushar, good question. You can hedge with the same contract if you want, or you can hedge with the next month contract or the next one after that if you want to. You can hedge with any of the contracts. It makes no difference. In fact, someone in my private group pointed out yesterday that it was advantageous to hedge with not the front month contract for this, because we were in a hedge a couple of days ago, but with the following contract, and which had a better hedging price, slightly higher than the front month. So yes, you could hedge with different contracts for sure. What is the point if you just cut your position? Alex, I explained why hedging is useful earlier. All sorts of psychological reasons and technical reasons and trade management reasons. I don't have time to talk about those. Yeah, right now, folks, I'm going to get back to the markets. Markets are open, and in about 2 minutes' time, and I need to be ready to get my trades going. I've got a couple of trades I want to put on, and two trades I want to put on, 2 trades I want to put off. Folks, thanks for attending. I really appreciate you being in this webinar. Thank you so much. I don't take your presence for granted at all. I know it's taken time out of your day, it's effort. You've got to fire up the old computer, get the internet fired up as well. So it's a bit of a pain. I know sitting in webinars can be tedious and boring, but I do appreciate you being here and taking the time. And please keep an eye on your email inbox, my YouTube channel, that's ArcisFX, and Twitter or X. And the handle there is also ArcisFX. Thanks, everyone. I appreciate you being here. I'll see you soon. And if you want to be in my live stream tomorrow at ArcisFX on YouTube, make sure you go across there now and just subscribe or whatever you need to do. Take care.